Hi, this is Dylan Kramer. Wanted to take 2 minutes here today and talk to you real quickly about something that came up in my first conversation of the day. Something that comes up fairly frequently, and I wanted to address it here so that you could have the benefit of the answer as well. And that is, hey, do I get a shorter term mortgage rather than get a 30-year fix because I hear rates are up? The answer is, it depends. The answer is always, of course, relative to mortgages. It depends. That's why you need to work with a professional. But specifically, shorter term loans depend on whether or not you have some sort of other financial plan. A good short term mortgage is part of a solid fundamental financial plan to get things paid off. I always try not to step in front of my business partners when you have a financial planner or advisor that recommends a 30-year fixed. But if you don't, or you're not exactly sure about their advice, let's talk about shorter term loans. There are two great reasons. First one is you're out of debt. There are two ways to impact your home your home and its equity. The first one is to cross your fingers, buy in the right place, and have your value increase. That's tremendous, but you don't end up in a situation where you can depend on that or you can reliably impact it. A shorter term 20 or even 15-year loan will dramatically affect it and put you in control of the equity by reducing the balance. Remember, your equity is the difference between what it's worth and what you owe. So the sooner you can turn around and drive what you owe down, you can directly impact your equity. So let's talk about numbers. First one is today's rates are tremendously spread out versus where they were in May of 2013. You now can get 4.875 on a 30-year fixed, and a couple of months ago where you maybe save half a point on a 15-year, today a 15 years at 3.875. It's going to save you 1%, and in this example on a $160,000 loan, it starts at an annual savings of $1,600 a year in interest. The numbers work like this. A 30-year fixed is going to be $327 cheaper than a 15-year fixed. 20-year fixed is going to be $150 cheaper than a 15-year fixed. But what are your trade-offs? When you take these monthly payment savings and then you look at what you pay off in principal over, say, 7 years, it changes dramatically. On that 30-year fixed, you're going to see a $20,000 reduction in principal over the first 7 years. It's not that much considering that you can see you're going to end up paying $1,300 a month in principal and interest. So 7 years of that builds you $20,000 in equity. But an increase of that payment to $1,638 a month total payment in principal and interest, you're going to put yourself in a situation where you build the equity by $43,000 more dollars. You're going to end up with over $60,000 in home equity on a $160,000 loan. So a shorter term mortgage will dramatically impact your finances. To talk about these and any other questions relative to mortgages, call me today at 630-343-9526 or email me at dylan@dylankramer.com, and I can prepare one of these reports for you or your clients to help analyze your specific situation. Thanks so much and have a great day.